Hi guys, and welcome to our podcast. Today we're going to discuss how to use MACD indicators in your trading and how to combine this technique with other technical analysis tools. As we said in previous analyses, the most important thing to do when investing money is to work on your trading strategy. Your capacity to stick to your trading plan will make the difference between success and failure. Indicators are often used by traders to decide when to enter and exit the market. However, choosing indicators is never easy, as you need to really understand them and know how to interpret them. One of the most popular mathematical indicators is the MACD indicator, which stands for Moving Average Convergence Divergence. This article will help you understand this indicator in depth, as well as know how to improve your overall analysis skills. So what is the MACD indicator? The MACD indicator was developed by Gerald Appel more than 35 years ago. It consists of two lines and one histogram. The indicator is usually at the bottom of your chart, as you can see in the image below. Its name comes from the fact that it compares two moving averages and displays when they are converging or diverging. A trading strategy based on the MACD indicator involves using buying and selling signals, based on a potential price increase or decrease being spotted. Initially, Gerald Appel discovered this indicator to highlight when momentum and prices are accelerating together, as well as when prices and momentum aren't moving in sync. The indicator is therefore used to measure momentum comparing two moving averages. As we can see on the above chart, there are three elements that make up the MACD. The blue line is called the MACD line, while the orange line is called the signal line. The purple bars represent the MACD histogram. If you use this indicator on your trading platform, you will see that the default values are 12, 26, and 9, but you can change them depending on your trading style. Now let's have a look at these three components. Number 1, the MACD line. This line is one of the most important components of this indicator. This is the fast moving average. It displays the difference between two exponential moving averages, a 12-period EMA and a 26-period EMA. Remember that a moving average, MA, is a trend tracking tool, which displays the average price over a given period. There are different types of MA. The EMA gives more importance to the current prices. Therefore, this type of moving average will more closely follow the price action than others, such as the simple moving average, SMA. The EMA is more accurate because it is more reactive to price changes and new information available. For more information on moving averages, read our article, How to Use Moving Averages in Your Trading. Number 2, the signal line. This line is the slower line of the MACD. It's a 9-period EMA of the MACD line. The third component is the MACD histogram. The histogram is an oscillator evolving around the reading of 0. It measures the trajectory of the MACD and will help you anticipate crossovers. The bars simply display the difference between the fast and slow moving averages. As you can see on the first chart, each time both lines cross over, the MACD histogram disappears. See black arrows. This is because the histogram is the difference between the two lines. When they cross, the difference equals 0, so the histogram doesn't display any bars. This is usually when a price movement is about to happen, as the histogram gets bigger when the lines separate. We can calculate the different components by the following calculations. MACD line equals 12-period EMA minus 26-period EMA. Signal line equals 9-period EMA of the MACD line. MACD histogram equals MACD line minus signal line. Now, let's discuss about the three types of signals that the MACD indicator provides. First, the MACD crossovers. Crossover buying and selling signals are the most used type of signals traders use with the MACD. It happens when the two lines cross. It displays the moment where the momentum accelerates. There are two types of crossovers, bullish and bearish. Bullish MACD crossovers occur when the MACD line crosses above the signal line. See the green circles in the chart above. This signals that the price of the underlying asset is likely to increase. Bearish MACD crossovers occurs when the MACD line crosses below the signal line. See the red circles. This signals that the price of the underlying asset is likely to decrease. Second signal is MACD divergences. Another type of signal used with the MACD is called divergence. A divergence happens when prices are moving in one direction, but the indicator is moving in another one. Bullish MACD divergences happens when the prices form lower bottoms, but the MACD forms higher bottoms. This signals that the price of the underlying asset is likely to reverse and increase. Bearish MACD divergences happens when a price forms higher tops, while the MACD forms decreasing tops. This signals that the price of the underlying asset is likely to reverse and decrease. In this example, we can see how important it is to use the MACD with technical analysis to validate signals. Basic technical analysis techniques such as supports, resistances, trend lines, and channels are easy ways to confirm trading signals. Let's have a look at the second divergence. The EUR-USD is going upward, forming new highs. However, MACD tops are lower. This bearish MACD divergence is confirmed by the price reversal. The currency pair trades above the major resistance for only 3 days. After that, it went back down, which also corresponds to a bearish MACD crossover. Let's zoom in. If you're used to trading with candlesticks, you can easily recognize the reversal pattern in the red circle. It's a shooting star. This is a bearish reversal pattern that indicates that the bullish pressure is losing momentum. The buyer drove prices higher, but the sellers took control during the day and pushed prices down. The selling pressure was so strong that prices ended up the day at their lowest level. This is an indication that traders should be cautious. The next candle is a bearish spinning top. The following candle is still bearish as it has a long red candle with almost no shadow, a bearish Marubozu. A Marubozu is usually an indication of a strong buying or selling signal. In our example, as the body is red, it's a strong bearish signal, especially as it happens on a major resistance level. As you can see, candlestick analysis combined with technical analysis will help you confirm trading signals coming from the MACD. The third signal we would like to discuss about is the overbought, oversold MACD. It's not a widely used feature of the MACD, but it can also give an indication on whether an asset is overbought or oversold. The MACD doesn't have a dedicated area where it spots both situations. You can, however, see it by looking at the distance between the two main lines of the indicator. To spot overbought or oversold situations, traders should be looking for important rises or falls in prices that do not match the trend. If prices increase or decrease too quickly, there is only a small likelihood that they can keep the pace and remain at those levels. Therefore, they are more likely to reverse. By looking at the MACD, you can spot these moments where the shorter moving average is diverging from the longer one. This is actually telling traders that prices of the asset have moved too far away from the historical averages. Thus, there is a high chance that prices will be forced to go back to normal trading prices. Remember, the MACD is a delayed and lagging indicator, as it is composed of moving averages. This indicator is very useful to avoid being against the trend. There are different ways you can get buying or selling signals from this indicator. You can mainly use MACD crossovers and MACD convergences/divergences. When there is a new trend, the fast line will react first and can cross the slower one. Once this crossover has happened, the strength of the movement can be seen by the space between the lines. When the fast line starts to move further away from the slower one, you can see that the new trend has started. To confirm trading signals, you can also use basic chartism techniques that will help you determine better entry and exit points. Make no mistake, entry and exit points are an essential part of your trading plan. You must work on them as much as you should work on your risk and money management. Remember to always use take profit and stop loss orders when trading, as it will protect your trading capital. Looking at previous important psychological levels on a chart will help you determine them. You can then use previous support and resistance levels. Do not forget to use a risk-reward ratio of at least 1 to 2. This means that you are targeting to earn twice the amount you are willing to risk. That's it for now. On our website, you can find more posts and podcasts. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Do you use MACD indicators in your trading? If yes, are they the only tools you use, or do you use them in combination with other indicators? We would love to know your thoughts, so feel free to share